Ray.
Welcome back to Switzer on Sky News Money. Since the election of Donald Trump, bond yields in the United States have soared, with the rate on the 10-year government Treasury bond hitting 2.5%. It closed on Friday at 2.42%. Our next guest says that yields are set to go even higher in 2017. As this is the bellwether for bond markets globally, what does this mean for the Australian bond, term deposit and property markets, and how should investors structure their portfolio to preserve capital in an increasing interest rate environment? Phil Carden is the portfolio manager of the Supervised Global Income Fund at Supervised Investments Australia. Phil, welcome to the program.
Hello,
you
Paul.
say that US bond yields are going even higher. So I suppose the first question, the obvious question, what's causing bond yields to go higher in the US?
I think it's fundamentally related to the election result in November, where the Republican Party won essentially all three houses in the US. They won the White House, the House of Representatives and the Senate, which means that we now have a government in the United States of America that can implement its agenda. And the agenda that the Republican Party have revolves around spending a lot of money on infrastructure, reducing tax rates. That's all quite inflationary, and also it's a large easing of fiscal policy.
So it's the expectation they're going to be inflation is going to pick up, or wage inflation might actually do something, and perhaps the US government will have to issue more bonds to fund the short-term deficit he's going to create. Is that the...
Definitely. They'll definitely have to issue more bonds. And as the budget deficit increases again with the lower tax rates, because it'll take time for the increased spending to feed through into higher tax collections. The markets looked at the bond rate, which going into the election was about 1.7. As you say, it's now 2.4, 2.42. And they've looked at the CPI, year-on-year inflation over there at 1.7%, as it was last year in November, and they've said, well, these bond rates are just too low.
Now, the market's talking about perhaps two further Fed tightenings, or tightenings by the Federal Reserve this year, with their cash rate currently somewhere between 0.5 and 0.75%. Is the bond market saying that there could be even more than two?
Look, the people I speak to in the United States, in the Republican sector, are expecting very aggressive increases in short-term rates by the Federal Reserve Board this year.
So potentially more than two? Is that what...
Well, they think they're heading towards three. Whether that occurs in a year or not, I mean, I'm not sure about the magnitude. I think the important bit of it is that the market's probably going to be surprised about how aggressive it is. And that relates to the fact that the theory being espoused by the Republicans is that they were held down prior to the election in favour of the Democrats, and now that the election's out of the way and we have such strong employment growth and such emerging inflation and plans for this fiscal expansion, that those rates are going to have to go up.
So deflation is dead? And was it dead? Wasn't that long ago people were talking about deflation?
That's a big word, but it certainly looks that way in the United States. I mean, we've had a contraction in the GDP in Australia in the last quarter, and really what's important, I think, is how Australia deals with this, and I could sort of go over that.
OK, so let's come to Australia, because the US is the bellwether market, a bit like equities. If bond rates in the US go up, our bond rates in Australia have also gone up, at least in the sort of the longer maturities, 5 to 10 years. I mean, so is this bearish for Australian bonds, what's going on in the US?
Well, I think it's definitely bearish. I mean, I've never seen US bond rates trading at yields below Australian bond rates, and as you know, we started trading bonds in about 1980.
Bond trading from the old days, right?
Hasn't been seen. We're at a margin of about 0.6, 0.7. We've been out as wide as sort of 2%. So I think if the US rates are going up, and we're quite confident of that in the long end, the Australian rates will follow. If they don't, I guess we're going to end up with a very, very weak currency and all sorts of other problems. All these things are connected. So I think...
So given that people at least haven't given up totally the chance of another interest rate cut in Australia, then of course the Reserve Bank cash rate is an overnight rate. Does that mean, if you're talking that what's going on in the US is got to be ultimately means higher bond rates in Australia at the shape of our yield curve is going to continue to steepen?
I think we'll probably initially see a steepening in the yield curve. I think we'll see a larger differential between the cash rate, 1.5%, and the bond rate. That could increase, maybe to as much as sort of another... to about 1.5%. We've got the bonds at the moment about 2.7, the cash at about 1.5, so that could steepen up. I think it probably will, but we've also got to take into consideration that the Australian government also appears to be looking at some fiscal easing and some expenditure, as was reported in my OFU. So those things will tend to offset it. But yes, I think we'll get bigger differentials between longer and short rates.
And so let's bring it back to what an investor does. I mean, obviously, if you're in a bond fund, you might be wanting to look at the duration, the length of the term of that fund. Is that what would you be advising investors who had money in bond funds to think, do they need to consider thinking about shortening a little bit, or...?
Well, as you mentioned, we run a bond fund, the Supervised Global Income Fund. We've got a duration of about our bond average maturity rate for interest rates in our bond fund is about 1 month.
And that's very, very short, right?
You can't get it any shorter, really. So, you know, we've had a very good half year. And we would recommend that everybody looks at floating rate assets in the year ahead.
So these are bonds that, rather than having a fixed interest payment, the interest payment resets every 90 days or 180 days, whatever it is,
Yes, that's right. So you can get bonds that float at 5% above, essentially, the Reserve Bank cash rate, or what's known as the bank bill rate. They're both much the same thing. And so as those rates go up, your income rate on that bond will go up, but the most important thing is you're not fixed into a fixed rate at, say, 1.5% or 2%, because when a bond rate, a fixed rate of 2% goes up, the capital value of the bond needs to go down and you're losing money. We did a sum on the US market in September. We were talking to the Self-Managed Superannuation Fund Trustees Association, and we predicted back then that we thought the bond rate in the US would go to about 5%. At the time, it was at about 1.6. Now, if that occurs, that's going to be about a 30 to 35% diminution in the capital of a 10-year bond. So that's quite a big loss.
So you can actually lose money in 10 years, despite what people say, at least in paper, on 10-year bonds. So what does it mean for other asset markets? What does it mean for things, you know, bond substitutes, perhaps things like listed property trusts? You know, is it bearish for that, or do you think the markets, there are different dynamics here at play that...
Well, just on the equity market, I think if we're seeing an easing in fiscal policy and reductions in tax rates, that could be good for companies. And that fiscal easing may offset the increase in the 10-year cost of prime rate money. In the property market, I think it's quite clear, certainly in Sydney and Melbourne and quite possibly also up in Queensland, that a lot of the future value of rental yields in the low interest rate environment has been discounted into the present value of properties, i.e. they've gone up by about sort of 30% in the past couple of years. So if interest rates do go up a lot, well, then one would expect that rental yields may have to follow, and in that... That's just looking at those two things in isolation. And in that environment, well, it's possible you might get a small correction in property prices. But really, the biggest one I've ever seen was back in sort of 91, 92, when the median house price dropped by 30%.
I don't think you're foretelling that. OK, so just for investors, particularly self-managed super funds, what would you be sort of saying to trustees at the moment? How should they be positioning themselves?
Well, we're recommending very strongly that you stay in floating rate securities. And wait for opportunities in either the equities market or the property market where prices may react to some of these changes in monetary policy, because these are very big changes, which we haven't seen for nearly 8 years. So there could be some sharp... It might not be long-lasting, but certainly in the equity market, I think having a bit of cash in the floating rate market in bonds, and you can liquidate them and maybe move back into equities if we see some opportunity.
OK, well, I think the note of caution about the bond market and thinking about that's really important. Sometimes a return of 0.5% isn't a bad return. It's better than losing 5 or 6%. So,
absolutely.
And I think investors need to take that in mind. So, Phil Carden, the portfolio manager with Supervised Global Investments, thank you very much for joining us on Switzer.
Thank you, Paul.
After the break, Peter Switzer calls her the Princess of Property. Margaret Lomas joins us on the desk for a pulse check on the residential property market.